So before I start this video, a quick warning. After you complete this video, you are never going to look at the news the same way again. Because every time you'll hear that the markets fell today or the stocks had their worst month in years, you will know about the number hiding in the background that almost nobody talks about. That number which quietly controls stocks, housing, startup funding, and yes, the EMI on your home loan. That number, it's not the company's profit, it's not the GDP, it's not even the RBI's interest rate. Though we'll get to know how these are connected, but it is the 10-year treasury yield. And by the end of this video, you'll understand it better than 95% of the people who are working in finance. Right? So imagine this. A company is earning exactly the same amount of profit as it did yesterday. Right? Nothing really changed. The housing market is as it is, the startups are as it is, and no changes in crypto. But what if every one of them suddenly fall in value? Why it happened? Because somewhere in the background, one number, that is the 10-year treasury yield, that number moved. It increased and it made them fall in value. Right? So, why do professional investors obsess over government bond yields? See, treasury yields are basically financial systems, thermometer, speedometer, and gravity. And on top of it, all at once. So even a tiny move is capable of erasing trillions with a T from stocks, real estate, startups, and crypto. Right? So first we'll try to understand what exactly treasury bond is, and then we'll be able to figure out about all these things. So treasury bond is simply, you become the lender. You have the money, you borrow it, you give your money to the government, right? You lend your money, government becomes the borrower, and annually you get paid in form of coupons or interest, whatever you want to call it. Treasury bonds are basically special. Why? Because government are considered to be safest borrowers on the earth. And why are they considered? Because what government can actually do is they can actually print more money, or basically raise the taxes to actually pay you back. So this is why they are considered really safe investment. So how it actually works is, let's say your investment is 1 lakh rupees, and you lend that money to the government, and government gives you a bond in which the coupon rate is 6%. So basically you will receive an annual interest rate of 6,000 rupees from the government, right? So the government borrows your money and pays you interest periodically. At the maturity, you'll get the principal that you initially invested, and yearly you'll get the annual interest. Right? So the government can print more money or raise taxes so that they collect extra revenue and are capable enough to pay you back. So this is why treasury bonds are often considered to be a risk-free asset. They are so special because they have actually become benchmark, because they are so safe, right? And they are the benchmark for actually judging all other investments. It is safest because, see, US treasury is closest things to being the risk free in the financial world. It is highly liquid. See, trillions of bonds, or the treasury bonds, are basically traded daily in volume of trillions, right? They're easy to buy and sell, right? Because they are the safest, so they're not moving the price much. It is often considered to be the benchmark for what? Bonds, loans, asset. And basically these are price relative to this yield. See, for understanding this particular, you have to understand the concept of CAPM, which is the capital asset pricing model, in which we consider the risk free asset, right? You add on basically the equity market premium, this is, which is basically the return from market minus the risk free return, and you multiply it by beta. This is of a particular stock when you are calculating. right? So this risk free return is nothing else but the treasury bond return, right? So I guess for now it is enough to that you understand this particular formula. And I'll make sure that I make a separate video on this particular topic, because capital asset pricing model is a very very important formula in finance. So why particularly the 10-year yield rules everything, right? Suppose you are managing billions of dollars of in portfolio, right? What options do you have? You can either invest in government bonds, which are safe and they have predictable returns. When we are talking about stock market, the returns are often higher than government bonds, but the risk is also higher. The volatility, the cyclic nature of some stocks, everything, the liquidity problems, right? So the risk is higher overall, right? Real estate is basically a physical asset. You have to use a lot of leverage to actually get a hold of it, and it is a time consuming asset, right? It's not really liquid, right? Then we have the funding like startup VC, right? So the risk is way too high and the reward is way too high as well, right? So before investing, where you would ask a simple question: where could I put my money so that my investment is safe, which is risk free return, the safest option. Without a problem, without even moving your hands, you can earn a comfortable interest with the help of government bonds. So what happens so let's do a comparison basically, right? So treasury yield is at 5%, the stock return is at 6%. What is happening with this 5% is it is absolutely safe. You have a guaranteed return and a zero credit risk. Zero. Make sure that you remember that the government can actually print more money. See, it's not obviously a viable solution, but things can happen anytime anyway. Or they could increase the taxes, which could ultimately boost their revenue, and they could have the capabilities to pay you back. But we're talking about when we're talking about stock market return, see the difference is of 1%, right? For 1% you have to deal with the volatility of the equity market, right? You have to make sure that you understand the company's risk, the unsystematic risk that it comes with, all the internal factors, right? You have to understand about the economic uncertainty related to that particular company and the stock market, right? This is a very global formula, right? So this question: would you really take stock market risk for just 1% extra return? See, this question doesn't really have a single correct answer, right? Some people would definitely choose this over this any time of the day, right? It's just what your investment philosophy is. See, if you are a loss aversion, right, you would definitely love to make sure that okay, the 1% could go, I am happy with 5%, because what this 6% is the expected, right? What could happen if you are investing in a particular company due to the company's underlying and systematic risk? What could happen is you could actually make your this could actually make your investment total zero. Forget about the returns, it could make your capital go away, right? And the same thing happening with treasury yield is really uh, not something that we can see very often, right? So if you are loss aversion, your investment philosophy is making sure that you have as minimum loss as you can. So yes, maybe uh, you would definitely choose treasury yield. But if you are a risk taking person who loves to take risk, you would definitely enjoy this 1% thrill, right? This sitting comfortably at home with 5% is something that is not gonna give you conviction in your mind, right? Playing for that 1%, if you are a risk taker, this 1% is much more than the 5% easy return. So here also comes the opportunity cost formula, right? Let's say this is an ideal situation in which treasury yield is giving out 5%. What if I tell you that stock market is giving out 4%? Would any one of you be interested in investing at 4%? Why? Because 5% you can easily get in treasury yield, right? So what happens is, see, what is happening in your mind is you are understanding the opportunity cost. If you are investing in this 4%, you are losing 5%. That is an opportunity cost if you are choosing stocks, right? But if you are going with this, then this 4% becomes opportunity cost, and choosing this, because this is 4% and this is 5%, this actually becomes a very good choice. Your opportunity cost should always be lower than what your expected returns are. Then and only it makes a certain sense, right? And this is why treasury yield becomes a hurdle rate. Hurdle rate is nothing else but a rate which any other investment or an asset should make sure that they come above it, right? This is the hurdle rate. This is the minimum benchmark that treasury bond is setting up, because it is risk free, right? So other asset must clear this bar. It is creating a hurdle, it is creating a bar, just so that other assets risks are justified. So why stocks care about yield so much? We'll talk about it in a more mathematical manner. See, let's say a scenario where we talk about the yield rate is 2% and the discount rate is 2%. Now, for this particular example, you have to make sure that you understand understand the concept of time value of money. See, if I tell you, if I give you a situation, would you like 90 rupees today or would you like 100 rupees? See, okay, let's leave this. Would you like 100 rupees today or 100 rupees after 1 year? Right? What would you choose? See, it depends. Right? Now, let's say from this 100 rupees, what you are doing, you are buying 10 liters of milk, because the price of the milk is 10 rupees per liter, right? So you are able to buy 10 liters of milk, right? Today, this is 1 year later. What would be the situation after 1 year? See, what would happen is you still need 10 liters, but the problem is, due to inflation, the milk might cost 11 rupees. So you would actually end up needing 110 rupees, right? So what you would have to do is to compromise on the quantity, right? So due to inflation, the price actually increase, so you either have to decrease your quantity or you have to increase the cash flow. So this makes it logical, right? Choosing 100 rupees today, because you can actually, because with time the purchasing power of the money, of the same money, same 100 rupees, is actually decreasing, unless and until you are in a deflationary environment in which pricing tend to be uh, getting low year by year, right? What we experience in Japan, in my I talked about it in my previous videos, in a case study when we talked about Japan, right? So to understand, we have a formula of present value. So what happens is, let's say, uh, talking about this particular yield, the yield is 2%, right? Now, would you like 82 rupees today or 100 rupees after 1 year? What if I give you this particular situation? What would you choose? See, what is happening, if I give you 82 rupees today, you can invest at a treasury yield that is giving you 2%, right? And after 1 year, it will become 100 rupees. After 1 year, it will become 100 rupees. So getting 82 rupees today or 100 rupees after 1 year basically means the same thing, if you are investing in something of a treasury yield. So this is basically a discounting formula. You are using treasury yield as the discount rate, right? So you are multiplying when you're going to the future value. When you're calculating the future value, you are multiplying. So if you want to find about the present value, present value lies here, the future value lies here, right? So you have to divide. So hence the division. So it becomes 82 rupees. So basically, getting 82 rupees today or 100 rupees after 1 year is the same thing if the treasury yield is 2%. But if the treasury yield becomes 8%, discount rate becomes 8%, right? Because we are actually discounting using the treasury rate. So divided by 100, it comes to 46 rupees. So just because, see, let's come to the example now. A company is expected to generate 100 rupees in profit in 10 years from now. Its value today depends on the discount rate, which is heavily influenced by the treasury yields. Right. So we are calculating the value of the company today. Right. We are actually this is the exponential. This is basically the number of years. Right. So basically the formula is, this is the face value. This is not a future value. This could be face value or the future value as well. So we are dividing it by 1 plus the discount rate. Right. And we have the I'm clear it a bit, and we have n here. So this is the discount rate, this is the number of years. So this is 10, this is 0.2, so 1 plus 2%, right? So this is the formula for present value. Now what is actually happening is, if we are discounting the cash flows, we are discounting the cash flows 10 years. The exact same business, nothing about the business has changed. Nothing about the business has changed. It is still generating 100 rupees in profit 10 years from now. But due to the treasury yield and the discount rate, right, which is absolutely the same thing, the company is worth 36 rupees less just because the yield actually rose. Now I hope you can understand the comparison between what is happening and how is treasury affecting so many things, right? We talked about here, right? We talked about how it is influencing stocks, housing, startups, and crypto. We'll talk about it more in depth, so it will be much more clearer to you, right? So the company never really changed, but the discount rate was something that actually changed. Now you have to understand one more thing about it, right? When we're talking about growth stocks, essentially tech or startups. See, when you are in the growing stage of a business, right, you have to understand economics here, right? When you are in the growing stage, what you do with your excess profits and your money, you are totally investing those in making sure that you don't miss any opportunity. So you are basically on a continuous loop reinvesting your money, right? You're basically reinvesting your money. So whatever the gains would be for your company would be showcased in the further years, right? I am sure that whenever you'll open YouTube, whenever you want to start learning about finance, one basic concept would never leave your side, which is compounding. People often try to, and it's true at some level, that compounding can make such a big difference in your life if you do it and you use it the right way. But the problem here is, the growth companies are basically would be generating most of their profits far in the future. So what the discount rates is, basically they are punishing them for the distant cash flows, because for the initial years the cash flow is going to be either negative or maybe zero. The cash flow would be there, but talking about profits or maybe cash flows as well, right? So what will happen is, the compounding effect would have a negative impact in this particular situation. The 6% yield versus a 2% yield doesn't just reduce the value, it can have more the present value of the growth stocks. So it is much more difficult to judge. So this is why whenever the treasury yields spike, Nasdaq often hits the most, right? Now we have to find out about, we talked about it is affecting your EMIs as well. So we have to talk about the missing connection with your EMI. So what is happening? Let's take a look at the interest rates. Let's say, see, these are interconnected, of course, right? This is quite obvious that treasury yields are connected with the interest rate. So what is really happening is, let's say you want to buy a home, right? And you want a loan to buy that home for 50 lakh rupees for a term of 20 years. So with the interest rate of 7%, your EMIs comes out to be 38,765, and with the interest rate of 10%, your EMI comes out to be 48,251, right? Now there's such a big difference between the monthly EMIs. What would you prefer? In what environment would you prefer buying a home loan? When the interest rates are less, obviously, right? Total interest would be 43 lakh in this particular situation and over 66 lakh in this particular situation. So whenever the interest rates are lower, the demand for the home loan would rise, right? Which would bring sellers in the market. So which would actually increase the buyers in the market. So what happens when the buyers are more than the sellers? The prices tends to go up, right? But when the interest rates is higher, what will happen? The demand for home loan is going down. Why? Because it is expensive, right? When the buyers are going out of the market, the prices of the real estate is going to come down. So a house basically never really changed its shape, or it never really became bigger. The financing was 9,500 rupees per month more expensive, right? So when the yields are higher, what happens to the affordability is the buyers are less. So demand ultimately weakens, and people tend to delay purchases. They basically wait for the rates to fall down, and the transaction volumes ultimately slows down, right? Fewer borrowers because the EMIs are quite high, right? So EMIs are quite high, and basically it is creating more and more interest rates. So because there are few buyers, demand weakens, and house prices face a downward pressure as buyer pool shrinks. So what happens in corporate borrowing and investment decisions? See, talking about a corporation or a business environment, yields are affecting the borrowing cost, as same in the same way it was affecting the homeowners, right? So when the borrowing cost is at 5% or the borrowing cost at 9%, as a business, try to make a decision when would be the right time to invest. Of course, when the yields are low. When yields are low, the borrowing cost is also low. When yields are high, the borrowing cost is bound to be high, right? So basically, it is costing 4 rupees extra, 4 crore rupees extra for that particular investment. The same exact expansion project suddenly becomes much less attractive because the borrowing cost rose by 4 percentage points, right? So you have to understand about this percentage points whenever we're talking about. See, 9% minus 5% is 4 percentage points, right? Let's say 10% to 20%, it's not a 10% increase. 10% increase would be 11, would lead to 11%. Percentage points is basically this. When you say interest rate rose 10% from maybe 20% from 10%, rose to, not from 20 from 10%. So it basically could mean that the interest rates are now 12% and not 20% or maybe 30, right? So what happens? Factories are getting delayed. There are no new plants in the economy. No R&D is being done. Hiring is put to hold. So the jobs are not created, and hence economic growth eventually slows. The GDP hits, consumption hits, and the confidence takes a hit. Right now, who are actually dominating the treasury market? See, pension funds. Pension funds can take the least amount of risk. They want to make sure that their principal is well accumulated because they have a lot of responsibilities on their shoulders, right? They are extremely sensitive to yield changes, right? So they are the biggest investors in the treasury market. Talking about insurance companies, match assets to future claims. They are huge treasury holders. Sovereign wealth funds as well, and central banks as well. They use tools and tricks like quantitative easing to directly take advantage and move the yields. Now, The giant investors, what and how are they making these decisions? What they are using is they are forecasting and tracking inflation. Will the prices rise or fall? This would basically impact the interest rates, which will impact the bonds, or the other way around. They are tracking the economic growth. If there is strong growth, the yield would be higher because more borrowing and inflation risk. If there's a recession risk, there's a fear of downturn, right? So RBI Fed policies expectations priced into the curve. Treasury yields become the real-time summary of what the world's largest investors believe about the future, right? It's quite obvious. That's why traders, CEOs, and policymakers watch them obsessively. Right now, let's talk about few real world case studies. Right, this is going to be very very interesting for you. So, on September 2022, the UK government announces unfunded tax cuts, bond markets panic, and US government bond yield spike, right? And that happened quite dramatically and rapidly. Now here's where it gets technical and important. US pension funds were using a strategy called liability driven investing, LDI, and without getting into all the details, sudden yield spike triggered what are called collateral calls. Pension funds suddenly needed cash and they needed it fast. They started selling assets to raise it, but everyone was selling at once, so prices were collapsing and a doom loop was forming. The Bank of England had to step in and buy bonds urgently to prevent a complete fire sale collapse. UK pension funds nearly went under, not because of a stock market crash, not because of a banking crisis, but because government bonds yield moved too fast. So, yield risk is absolutely real. Bonds yield affect far more than just the bond prices. They can trigger a systematic stress in places you would never even imagine. Alright, coming to the second one, what happens when the yields are too low? From 2010 to 2021, central banks around the world kept interest rate near zero. Treasury yields were historically low, and safe government bonds were essentially paying you nothing at all. So, what did investors do? They went hunting for returns. Venture capital exploded, tech valuations went to the moon, crypto surged, special purpose acquisition companies raised billions on pure hype, meme stocks, NFTs, all of it, right? Because when you can't earn anything safely, you have to take risk, right? So then in 2022, yield rose sharply, and the reverse happened instantly. Capital rotated back to safety, and risk assets got starved of liquidity. The crypto markets lost trillions. Stock tech stocks basically crashed, and the speculative bubbles was starting to deflate. Right. So now the talking about the global dimension, because treasury yields don't just affect Americans and Indian markets, they are affecting every emerging economy on earth. When US treasury rose to 5%, which is a safe liquid guaranteed 5% return from a global investor sitting in Singapore or maybe London, why would they take the risk of investing in an emerging market that might offer 7%? Again, that contradiction. But with that comes the currency risk as well, political risk as well, and liquidity risk as well. So the answer is only if that extra 2% is enough to compensate all those currency, political, liquidity risk, and sometimes it's not really enough, to be honest. So the capital flowed back to US, emerging market currency started to weaken, the governments had to raise their own bond yield to compete, which basically raised the borrowing cost. It's a knock on effect that reaches every economy that is not the US, right? So, understanding at every level of the economy for individuals and family, it is affecting the savings rate, the FD returns, the home loans, whether they can afford a home or not, right? So, the retirement corpus growth, investment choices they have to make between the stocks and the bond, right? This is how it is influencing the individuals and family. Talking about companies and institution, it is directly putting a burden on the cost of capital for expansion, M&A, viability, projects IRR hurdle rates, hiring plans of the companies, R&D budgets, and the dividend policy. Talking about the entire economies, it is affecting GDP growth, housing markets, employment, inflation expectations, currency strength, fiscal space for the government. Now, what we have observed over the past time is that treasury yield, whenever it increases the discount rates with it, which actually leads to a reduction in stock valuation. When the treasury yields rise, the mortgage rates also rise, which decreases the housing demand. When they increase, the corporate borrowing increases, cost of borrowing increases, and the investment goes down. When the foundation, this is the foundation on which everything is built, it moves, the top moves as well. This is the top, this is the base. Whenever there is a movement in this is bound to move, right? So treasury yields aren't just bond numbers, they are the price of time, risk, and money. When treasury bonds or yields move, they change how every other asset is valued. That's why traders watch them, CEOs watch them, and entire market reacts to them. If stock are just the headlines, treasury yields are the operating systems, right? So I'll definitely request you to subscribe if you want such a deep and visual explanation about these financial jargons, terms, technologies, and anything else. So we'll end the session with some formulas, right? So when we're talking about treasury yield, it is basically the annual interest divided by the current bond price, which ultimately tells you your income relative to what you paid for it. So simple yield is equals to a coupon income divided by the price you paid for that particular bond. Talking about risk premium, it is basically the expected return minus the treasury yield. What I just told you about in CAPM formula, I mentioned it like this. So rate of return the market is giving you, this is for a particular stock trading in the stock market. This was the expected return from the market, and you subtract the treasury yield, the risk-free return. So the extra return that you demand for taking the risk. So rather than investing in treasury yield, if you want to invest in a market, so you want to get extra premium for that. Talking about present value, so formula for present value is when you have future value, you divide it by the discount rate on the number of years, right? So future cash flow discounted back to today. Talking about corporate borrowing cost, it is basically, this is just an there is much more to the formula than these two. So basically the treasury yield and the credit spread. So companies pays more than the government due to default risk. Talking about the mortgage rates, it is treasury yield plus the bank spread plus the margin, right? Your how your EMIs are basically price. Home loans price of benchmark plus the profit. Thank you.